Welcome back to Muscular Brain, Fat Wallet. Today, we're going to tackle a crucial topic that can save you thousands of dollars over the life of your mortgage: how to secure a low-interest mortgage loan from your bank. Whether you're a first-time homebuyer or looking to refinance, knowing how to navigate the mortgage process is essential. With interest rates fluctuating and the real estate market constantly changing, understanding the factors that influence your mortgage rate can make all the difference. From your financial profile to the documentation you need, we're diving deep into everything you need to know to secure the best mortgage rates available. So grab a notepad and a cup of coffee, and let's get started. Section 1. Understanding mortgage loans. 1.1 What is a mortgage loan? A mortgage loan is a type of loan specifically used to purchase real estate. In essence, the borrower borrows money from a lender to buy a home, and in return, the home serves as collateral for the loan. 1.2 Types of mortgage loans. There are several types of mortgage loans available, each with its unique features. Fixed-rate mortgages. These are the most common types of mortgages. They have a fixed interest rate that remains constant throughout the life of the loan, providing predictable monthly payments. Fixed-rate mortgages typically come in terms of 15, 20, or 30 years. Adjustable-rate mortgages, ARMs. Unlike fixed-rate mortgages, ARMs have interest rates that may change after an initial fixed period. This means your monthly payments can fluctuate, often resulting in lower initial payments but potential increases later on. Government-backed loans. These include FHA loans, VA loans, and USDA loans, designed to help specific borrower groups. They often come with lower down payment requirements and favorable interest rates. Section 2. Profiles. Banks prefer. 2.1 Ideal borrower profile. Banks are generally looking for borrowers who present minimal risk. This often includes individuals with stable incomes, strong credit histories, and substantial down payments. 2.2 Stable income earners versus commission earners. Stable income earners. Banks prefer borrowers with a stable income because they pose less risk. For instance, salaried employees with a consistent paycheck tend to be more attractive to lenders. They can demonstrate their ability to make regular payments, reducing the risk of default. Commission earners. On the other hand, commission-based earners can face challenges. Their income can be variable, making it harder for banks to assess their repayment capacity. However, if a commission earner has a solid history of earnings, banks may consider an average of the last 2 years' income for evaluation. 2.3 Criteria for business owners. Business owners must provide a different set of documents and may face additional scrutiny from lenders. Banks prefer businesses that have been operating for at least 2 years and show consistent profitability. Key documents include: 1. Profit and loss statements. 2. Business tax returns. 3. Bank statements for the business account. 2.4 Preferred age groups. Age can influence a bank's assessment of a borrower. Young professionals, 20s to 30s. This demographic is often viewed positively because they have a longer time horizon to pay off their mortgage. However, they may lack credit history. Middle-aged borrowers, 40s to 50s, typically have stable incomes and established credit histories, making them ideal candidates. Senior borrowers, 60 plus. While they may have the financial means, banks could be concerned about longevity and potential retirement income loss. Section 3. Financial stability and documentation. 3.1 Importance of financial stability. Financial stability is crucial for mortgage approval. Lenders assess your financial health through your credit score, debt-to-income ratio, DTI, and overall financial history. 3.2 Documentation required. When applying for a mortgage, you'll need to provide several documents. 1. Proof of income, pay stubs, tax returns. 2. Asset documentation, bank statements, retirement accounts. 3. Credit report. 4. Identification documents, government-issued ID. 3.3 Preparing financial statements for self-employed individuals. Self-employed individuals must present clear financial statements to demonstrate income stability. Engaging a CPA can add credibility to your financial documents, making it easier for lenders to trust your claims. 3.4 Credit score essentials. Your credit score is one of the first things banks look at when evaluating your mortgage application. A score above 740 is generally considered excellent and can help you secure the best rates. Section 4. Tips for securing a low interest rate. 4.1 Improve your credit score. Check your credit report. Regularly check your credit report for inaccuracies and dispute any errors. Pay bills on time. Consistently paying your bills on time is crucial for maintaining a good credit score. Reduce existing debt. Aim to lower your credit card balances to keep your credit utilization ratio below 30%. 4.2 Save for a larger down payment. A larger down payment can lead to better loan terms. If you can put down 20% or more, you can avoid private mortgage insurance, PMI, and may qualify for lower interest rates. 4.3 Shop around for rates. Don't settle for the first offer. Contact multiple lenders to compare rates and terms. Even small differences in interest rates can lead to significant savings over time. 4.4 Choose the right loan term. Consider your long-term financial goals when selecting a loan term. Shorter terms may come with higher monthly payments but lower interest rates overall, while longer terms offer lower monthly payments but more interest paid over time. 4.5 Understand the market conditions. Keep an eye on economic indicators and market trends. Timing your application when rates are favorable can lead to significant savings. Section 5. Understanding lender preferences. 5.1 What banks look for in a borrower. Lenders will evaluate your credit score, DTI ratio, income stability, and overall financial profile. Being aware of these factors can help you present a stronger application. 5.2 How to present your profile. Be prepared to present your financial history clearly. Use organized documentation and be honest about your financial situation. 5.3 Building a relationship with your lender. Having a good rapport with your lender can work to your advantage. Maintain open lines of communication and be proactive in answering questions. Conclusion. Securing a low-interest mortgage loan is not just about having a good credit score, it's about understanding the mortgage process and presenting yourself as a low-risk borrower. By improving your credit, saving for a down payment, shopping around, and preparing the right documentation, you can increase your chances of getting favorable loan terms. Remember, your mortgage is likely one of the most significant financial commitments you'll make, so take the time to research and prepare. With these tips, you'll be well on your way to achieving your dream of homeownership.